Okay, so we did the handout and we talked about the Dow Jones Industrial Average, and we could see here, like I said earlier, there's only 30 stocks, but they are the 30 biggest stocks generally. So it does become a little representative because the stocks are all kind of equally big, so there really isn't as much of a mismatch in share price that I was showing before on the blackboard. But Dow Jones has a number of averages, including the transportation average, which is often looked at. They have utilities average, which is only 15 stocks. Now, the S&P 500 we were talking about, that's an index, and that comprises 500 of the biggest stocks. So you can see how that is more representative already, because it's not just the top 30 stocks, it's the top 500 stocks, usually the biggest size, from every major industry and sector. So it's a well-representative, broad-based mix than the Dow Jones Industrial Average. However, it primarily just measures large companies, and there are plenty of mid-sized and small companies that have different growth trajectories and different influences on the index and their returns. Now, the true index is calculated back to the 1940s as the base, and then S&P 500 is what was tracked back to the 1940s. But the S&P 500 does provide many other indexes for other types of stocks and sectors that if you the S&P 500 is the most popular, but they do have a whole series of indexes that cover many other different types of stocks. There is a New York Stock Exchange Composite Index, including all the stocks in the New York Stock Exchange. So that's more representative because there's a lot more stocks than 500. The Amex Composite, which isn't that telling. No one uses that. The Nasdaq Composite Index is all the stocks on the Nasdaq, and that's actually a pretty good index to look at. But a more popular one is the Nasdaq 100, often represented by the symbol QQQ, as far as an exchange-traded fund, which is the top 100 NASDAQ companies by size. All right. We have the Value Line Composite Index, which has the equal weighting of the stocks with large market shares. And the Value Line, they have their own, another whole list of different indexes they have. The Wilshire 5000 is probably the biggest one with 5,000 stocks from all the major exchanges. So this is probably the most representative. So if they wanted to see how the market was really doing over a one-year period, this Wilshire would probably be the closest to the actual total return of the market. The Russell 1000 looks at the 1,000 largest companies, so it's twice as big as the S&P 500 index. The Russell 2000 looks at the 2,000 smallest companies. And these indexes are very important because these are benchmarks for a lot of mutual funds. So a lot of mutual funds will look at small companies, and they may only have 50 or 100 small companies they invested in, and hopefully their managers were able to look at the 2,000 companies out there, small companies, and pick the best 100. So theoretically, they'd have a much better return than the return of all 2,000 companies, right? Wrong. Most small mutual fund managers can't beat the Russell 2000 index, even if they get to cherry pick the best 100 companies, the best 200 companies out of 2,000. They just can't beat it. Sad. There is the European Asia Far East foreign exchanges, so they do look at exchange for other parts of the world. Is anybody here from, say, Australia, New Zealand? We used to have a lot of students from there. Not much anymore. Anybody here from Queens? Brooklyn, Bronx, Staten Island, New York City? Okay. Anybody here from Suffolk County? Only 4 students from Suffolk County? 5? Okay. Just taking a little informal poll. Just curious. Here is a chart that looks at the S&P 500 index. It compares the Dow average compared to the S&P 500 index, and you can see how they track pretty similarly. You can see that their coefficient is pretty close. They have a very and I think because a lot of the Dow Jones Industrial Average stocks, the biggest ones, are also in the S&P 500. So there's going to be a natural comparison there. But they surprisingly, even though the Dow is really not a good measure of the market return, it still tracks the return pretty close to the S&P 500. Okay. There are also bond market indicators, and bonds are important because we look at what's happening today that's really going to affect the bond market. If you don't know the answer to this question, you haven't been checking out the financial news or keeping up with financial media, reading any financial papers, or just being connected to the topic at all. Yes, and who's going to affect the interest rates? Who's going to have an influence on them today? Right. So the Federal Reserve is going to talk about minutes and rates, and because everybody's sort of wondering when are they going to start raising rates? And when you raise bond interest rates, it makes the current bonds old and junky. So for example, you understand the concept that a 2013 Honda is more desirable than a 2003 Honda, right? And one of the reasons that 2013 Honda has a rear camera and it has a lot of new features and connect your iPod to it, and has, it's a lot more you get with the 2013 than in 2003. So if a new bond comes out at a higher interest rate, that's got to be better than the older bond with a lower interest rate. So what happens to the value of the older Honda? Does it go up or down over the time when new Hondas come out that are better? It goes down. So the value of bonds go down as well as new and better bonds with higher interest rates are created. Because if you have, both bonds are going to cost $1,000. So people start buying the bond with a higher interest rate. So the value, because the supply and demand of the other bond actually goes down because no one really wants to buy it. And when someone wants to sell it, they're going to have to keep lowering the price. And it gets to a point where the price gets to a point where now it matches the interest rate on the new bond. Because maybe you buy it for $800, so the return of that $200 plus the interest equals a new higher interest rate. So there are indexes that kind of track changes in the interest rates and their effect on bonds. And different types of bonds have different more or less effect. So higher interest rate bonds have more of an effect when interest rate change than lower rate bonds. And term also has an effect too. Longer term and shorter term have, so interest rates affect the bond market in different ways depending on the term of the bond and the riskiness of the bond. All right. So with interest rates so low, people are worried about, what happens to these bonds that are out here if interest rates start going up. And that worries a lot of investors in bonds, and they may want to sell bonds and put downward pressure on bond prices and increase the yields. But if the Fed comes out with a statement saying interest, we're not going to touch that for a long time, then everything will rally. The bonds will rally, then the stocks will rally, and then everybody will be very happy. But if they're going to raise interest rates, then bonds are going to do bad, and stocks are going to worry because raising interest rates reduces economic activity. If you increase people's credit card interest rates, bank loan interest rates, mortgage interest rates, and credit card interest rates, auto loan interest rates, then there's less people that can afford to buy things with this borrowing. So it shrinks the economy. So that's why stocks would be worried about interest rate increases. And that's why the Fed telegraphs them very gently and say, we're going to raise rates, not right away. It's only going to be a quarter point. We're going to go very slow. So the bond market and stock markets don't overreact because they found in the past they tend to do that. Okay, so let's talk about stockbrokers. So they're going to act as, the buyers and sellers of securities because you can't buy or sell stock. You need a stockbroker to represent you. It's sort of like you can't buy or sell a house. You need a lawyer through New York State law to actually represent the sale. And they're paid by commission. So they generate a small piece of the sale will be their commission. And they have to be licensed by the SEC, which we talked about in the previous chapter, in order for them to facilitate these sales. And the stockbrokers are the agents who can communicate with the brokerage firms. So if you go to any brokerage, they have to employ stockbrokers to make the transactions on the exchange. So the customer deals with the stockbroker deals with the brokerage, and brokerage has a direct link to the exchange. And everybody gets a piece of money the whole way through. And that's why there's so much money on Wall Street, and everybody gets all those big bonuses. Because they're all taking a piece of money from us every time we make a financial transaction. There is one exception to this rule, that you can buy stock directly from a company through the dividend reinvestment plans. So if you ever worked for a company and they allow you to buy their stock directly from the company without any exchanges or any stockbrokers, companies do have the right to sell the stock to you directly, which brokerages and stockbrokers and exchanges, they don't like when they do that because it cuts them out of those profits. And actually, it's kind of a rare thing. Very few people buy stock directly from companies. And not all companies will sell it directly. Okay, so brokerage services, these are different things that brokers can do for you. The main thing is buy and sell securities for you. They'll hold the stock certificates in their name, so you'll never physically have the stock certificate unless you actually request it. The brokerage holds all the stock certificates. That's what enables them to lend them to somebody else to short sell. So it's what they call the street names. So the stock certificates will be what they call the street name, will be in the broker's name, and they'll hold them in your account for you. And it makes it very convenient because when you want to trade a stock, you don't have to run down to the broker and give the stock certificates over. And that's how you used to do it in the olden days. You'd own the stocks, you'd have them in a safe in your house, and then you would bring them back to the broker and say, I want to sell these, and it just took a long time. Some brokerages will provide you research and economic analysis and statements detailing all the transactions and detailed tax analysis of your account. Now, you have the full service broker, right? So what type of people use full service things? They have two main characteristics. They're rich and they're lazy. So they want a full service broker to take care of everything for them, provide research, provide advice, even make the trades for me. So the full service broker will do all that, but for a cost. So it's sort of like a full service landscaper. They'll come to your house and they'll do everything and landscape your property, but you'll have to pay them, which is a lot more than if you just did it yourself with your own lawnmower, right? People can pay $600 a season for their lawn services needs, their full service lawn needs. Or you could be frugal and just cut your own grass. Did you know that when you look at millionaires, most millionaires cut their own lawns? We're not talking mega millionaires. People who are between $1 to $5 million, they still cut their own lawn. That's how they became a millionaire. They didn't throw their money away at all these services they could just easily do themselves. That's from the book, The Millionaire Next Door, which is also sponsoring this video. I'm kidding. No, but it's a good book. Those two books I would recommend. If you want to be a millionaire, The Millionaire Next Door is actually a pretty decent book. And a great book for stock picking is Peter Lynch's. He's the author, Peter Lynch, and it's called One Up on Wall Street. And it's a classic, and it's actually the book I read that got in high school that got me interested in trading stocks and wanting to trade stocks. Okay, now you have your discount broker, and the discount broker, there's much lower commissions. So a full service broker, you may pay $40 a trade. A discount broker, you can pay $7 a trade. But they're limited in research and what they can do for you and provide no advice. They just provide you a website, and you can just go to town. Sort of like a discount broker would be similar to the market watch game we're playing, where you got to do everything yourself, find the symbol, enter the order. So they focus mainly on the executing of the trades online and the speed and the efficiency of you trading online. And you don't even talk to anybody. You just do it yourself online. You can call them and you can talk to an actual live broker to place the order for you, but they're going to charge you more commission if you do that. All right. So if you do want to have a stockbroker, say you do become fabulously wealthy. You start a small business, and next thing you know, it's going public, and now you have all this money. Or maybe you cut an album, and it suddenly sold 20 million copies. Or you're a star of a TV show. Is anybody here a star of a TV show? All right. Well, maybe you're a YouTube star, and you have 4 million subscribers, and you make $25,000 a month on advertisements. This thing exists. That exists. And there's one guy that just does Minecraft videos and has like 6 million subscribers and makes a huge amount of money every year. It's ridiculous. I don't understand why I don't even like playing Minecraft. I don't understand why someone would want to watch somebody else playing it. But that's your generation, so that's all you. I'll just watch something on TV. So anyway, if you do wind up having a lot of money, you may want to get a stockbroker because you may not have the time to do this yourself. And the stockbroker could help you and talk to you, understand your investment goals, your type of investment style, the risks you could take, and you'll pay a higher amount, but hopefully you get a broker that does a good job and can make more money for you than you can make for yourself. But the average person in this room could probably make more money for themselves trading their stock after this class than using a stockbroker, because their returns, based on research I've read, aren't much higher than the I wouldn't say the uneducated small investor, but the college-educated finance major investor tends to have a higher return than most stockbrokers. All right. But the average investor, the small investor, definitely has a lower return than what a stockbroker can get them. So if you are going to be, after this class, you just don't ever want to think about finance or investing again, maybe a stockbroker is right for you if you have enough money. And here's, different full service, discount, and basic brokers. So you have the low end of the spectrum like First Trade, Scotch Trade, and then you have the middle area like Charles Schwab, E-Trade, Fidelity, TD Ameritrade, and then you have the high end like Morgan Stanley. And I would suggest if anybody here at a certain point is ready to open a brokerage account, based on what we discussed in Chapter 1, I'd go with the premium discount broker. Either Charles Schwab, E-Trade, or Fidelity are probably the better ones that to work with. And I'd even encourage you to go to their websites and check it out, look around, see what they have to offer, how things are organized. And you always want to pick the website that's more intuitive to you, that you feel like you can get the most out of and it's not so overwhelmingly complex and hard to work with. Okay, so different types of brokerage accounts. You can have a custodial account that maybe your parents have for you, where the parents or guardians handle your transactions. So if you have a rich parents, mommy or daddy, who has money and then wanted to put some in your name, they'll have what's called a custodial account. So, maybe it's a grandparent. So maybe your grandfather was like, yeah, I think you should get, 100 shares of the stock when you're born. And then, by the time you graduate college, high school will pay for your college. But grandpa invested in a VCR manufacturer, so that didn't work out well. He didn't know. He thought it was the future. Okay. The cash account, which this is the account I suggest you open as a newbie, is just an account where you only trade stocks and cash. There's no margin. And of course, you can have a margin account, which we discussed in Chapter 2, where you can borrow money from the broker and extend your leverage and your risk. And that's good if you're a really great stock picker and you seem to make a lot of money easily in the stock market. You might as well just get a margin account and leverage it up and make twice as much. And then there's a wrap account, where this is a rare thing, but this basically the professional money manager does everything for you for one flat fee. So you just pay one fee a year, maybe it's $2,000, and then all commissions and all trading and all activity that they do in the account is, sort of a flat rate. Sort of like Netflix. You pay one price for Netflix, you can watch as many streaming videos as you want or rent as many videos as you want, as opposed to Redbox, where you have to pay as you go, right? Anybody here use Redbox? Okay. There's no shame in it. It's just a box. It's red. You put a credit card and you get a movie, right? We all like movies. All right. So basic types of orders. We have our odd lot orders, which are anything that's really, they describe them as less than 100 shares of stock. I describe them as any weird number of shares. So professional traders and people who know what they're doing always trade in multiples of 100. 100, 200, 500, 1,000, 10,000. And those are round lots. And they're important because we can look at statistics to see the difference in trading momentum between odd lots and round lots. Round lots are the professional money managers and people who are professionally trained to trade stocks. Odd lots are just people who think they could have no real formal education and think that they're just good at day trading and can make money. And by the way, I've never met someone who day trades who's consistently made a lot of money. It's sort of, day trading is sort of like, it's less risky than going to, say, Mohegan Sun, which is a gambling place. But you could go to Mohegan Sun and for a few hours you could do really well. And what happens? You think you're the world's best gambler. So you keep gambling more and gambling bigger bets. But eventually, if you do that, the longer you stay at Mohegan Sun, the more likely you're going to leave losing money. And that's the same way day traders work too. You may have a period where you're doing well and you're making money, but the longer you day trade, eventually there's going to just be one trade that's going to suck all your profits out of you and make you go home with a loss and then burn you really bad. So it only takes one bad trade to wipe out months of profits. So I've never met a day trader I've met plenty of people, including myself, who thought they could do that, which only wound up in disaster, especially when there's an economic or financial crisis. And then that's why you hear about these people commit suicide based when the stock market crashes and things like that, because they just literally lost millions. You should never kill yourself over money, because money is just an artificial construct. It comes and it goes. It's here. It's not there. You make some, you lose some. It's nowhere, anywhere as valuable as a person's life. So you don't want to get so wrapped up in money that it destroys your life. And the one rule of thumb is when you trade, if you can't sleep at night or that you're worried or thinking about these trades continuously and it's ruining your life, sell it. Don't ever hold on to a transaction where it's causing you any type of stress or worry. Your risk level is way too high, and that's how you know. And I've used that rule myself a few times. I got into a couple of transactions, and I just had so much time checking it compulsively and thinking about it that I just said, oh, screw this, just getting rid of it. I don't care. It's not worth losing my sense of well-being over. And having a diversified portfolio will help to create that sense of well-being. We have market orders. A market order is, anybody here ever go to a market and buy food? Yeah, of course you have. I should say it like this. What's happening? We have technical difficulties here. I must have... Sorry. Don't raise your hand if you've been to a market to buy something before. Okay, so everyone's been to a market. I ask you not to raise your hand because I know how unresponsive you like to be as a student. Never say anything, never move your hands, and that's okay. I'll make it easy for you. But a market order is just that. You go to the supermarket to buy chocolate milk, you put the chocolate milk down, and you buy it, no matter what the price is. You don't even know, you don't care. It's always around some reasonable price, right? It's not like the chocolate milk on campus. Okay, so we have limit orders, though. So say specifically you wanted somebody else is going to buy this chocolate milk for you, like a stockbroker. And you tell the stockbroker, listen, I want chocolate milk, but I only want to pay $3 for it. So then, would the stockbroker buy it if the chocolate milk was $4? No. Would he buy it if it was $3? Yeah, because that's the limit that you set. Would he buy it if it was $2.75? Yeah, because it's even better. So why would he not buy if it's lower than your expectation? So these limit orders can protect you because you can put an order in, and the market moves so fast sometimes that you put an order in for $5, and you think you're going to buy it for $5, but now it jumped up to $7. And the next time you look, it's at $4. So now you just lost $3. But if you want to control, you can put a limit in. Maybe a stock trades between 50 and 60 every day, and you're currently looking at it and it's at 58. So you say, you know what, let me put a limit order to buy it at 60 because I know it hits 60 every day, so why should I buy it? 50. Buy it at 50. If it's currently at 58, I know it's going to hit 50 at some point today. Why should I pay 58 when I just put a limit order in and wait for it to buy it for me at, 50? So you can control, you don't have to sit there and day trade every minute of the day. You could set up these limits and buy stocks at prices that you're willing to pay. If it never reaches the price, you don't buy it, but then that's okay. There's always the next day. But, you could do a limit order good for just one day, or you could do a limit order, it's called a fill or kill. That'd be good for months. So if you have an idea that you'd like to buy the stock, but you feel like the price you want to pay, the stock's at $75, but you really would like to buy it at 50. You put a limit order for 6 months in, and then hopefully some point during that 6 months it has a bad day and goes down to 50, and you buy it. And the next time you look, maybe you bought it at 50 and now it's back up at 75. That'd be nice, wouldn't it? I got to back up there for a minute. I messed up. The fill or kill is an immediate order. It's the good to cancel that lasts 6 months or longer. So the fill or kill, that is asking once. And the good to cancel can ask many times. So let me I'll clarify this now that I kind of messed up for a second. Say that chocolate milk, right? So it's a fill or kill limit order. That means you go to the supermarket and you only ask to buy it once. And if it works out to be a good price, you buy it. And if it's not a good price, you don't buy it. So it's either fill the order right now or kill it. So it's sort of like instantaneous. It's a one-time asking, the fill or kill. The day orders will ask all day long. So envision this girl. What's your first name? Stephanie. She is at the cash register at Pathmark, right? And the whole day you're asking, can I buy this for $3 now? And they're like, no. Can I buy this for $3 now? The whole day from 9 to 4, you're asking that, 9:30 to 4, you ask that question all day. And they keep telling you no. Now, if it was a fill or kill, you just go in there and ask them once. They tell you no, you leave. If it was a good to cancel, you'd have to stand at that register at Pathmark for 6 months asking every second between 9:30 to 4 if you could buy it for $3. Eventually, they just get sick of you asking and be like, sure, just buy it and go. Because I have people like a whole line behind you, and this is insane. So think of it, so the market works kind of like that. Now, you would never sit there and ask more than twice. We're all fill or kill. We go to wherever we are, we're going to buy something. We find what the price is. We'd either buy it or don't buy it. So no one ever stands there and waits for the prices to change because the prices change so slowly in supermarkets. Unless it's like Thursday night at 11:59. And this is going to go on sale for Friday at 12:01 Friday. Any supermarkets open past midnight? Pathmark is open past midnight. Not Whole Foods, though. No, you only pay commission when it's filled. For any order, a limit order or a regular market order, you only pay commission when it's actually filled. If it's not filled, you don't pay commission. Because that could be a lot of commission if they keep asking all day long. You know. Now, there's something called a stop loss order. Now, these orders are basically, generally you own the stock first, and you're worried about the stock. So maybe you own a stock at $300 a share. It's a pharmaceutical. And you're worried that you bought it at $10 a share, now it's at $300 a share. But you're worried that news may come out that their drug doesn't work, which would bring the stock back down below $10 a share. So you can actually put a stop loss order in saying that if this stock falls to $250, sell it. And it just stays there until it reaches, as a protection. So that way you would never sell it for anything less than $250. And what you're hoping is that it goes from $300, $350, $500, $1,000. So you're owning it as, and then maybe if it's at $1,000, you could cancel the order and reset it up at $700. So you can kind of track the stock higher. So if any bad news comes out and it's going to crash, it'll sell it for you before you lose all your money. Yes. Yeah, but that's a little too advanced for what we're talking about right now. These people are just trying to wrap their heads around stop loss. But you could do percentages and trailing, and these are just other additional instructions that will automatically change your stop loss as a certain percentage of the total value. So you can put your stop loss at 75%. So if it's a $100 stock, it'll sell if it hits $75. But if it becomes a $200 stock, it'll sell at $150. So that way you don't have to constantly change your stop loss order. Yes. Yeah, negative side. Here's the negative side. It's a flash crash in the stock, and people think the bad news is coming out, and it goes to 200, but then, fake out, it's really good news, and it goes back up to 400. Now you sold it, and you lost out. It may have happened within 10 minutes, and you sold at 250, but now you look at your account, and the stock's at 400. So that's something that could happen. Now, a stop loss order automatically creates a market order when you buy and sell. However, so if you put a stop loss in at 250, it'll create a market order. It may buy it at 245, 252, whatever it's trading at, it's going to buy it at. Because by the time it executes, if the market's falling really fast, it may actually buy it at a lower rate because it's going to convert to a market order. You can prevent that with what's called a stop limit order. Now, the more fancier you make the order, the more commission you're going to pay. So the market orders are the cheapest, limit orders are a little bit more expensive, a stop order is a little bit more expensive, and a stop limit order is the most expensive. But here, you could say stop at 250 and make sure you sell it at 250. And those have priority orders. Since you're paying more commission, they get stacked above the market orders, and you'll definitely get the 250. So and now you can do these types of orders in the Market Watch game. They do have limit orders and stop orders, and you can practice these. And these are things that you should be doing. You may not know what's the perfect stock to buy to make money, but you could at least practice some stops and some limits and these types of orders. And now, for all these types of orders, you can do it with short selling, but it's sort of the stock's moving in the opposite direction. It gets a little bit more confusing, and you have to actually practice it to really understand what's the right way to set it up. Because sometimes people set these orders up, and they'll set the stocks at 50, and they'll set a limit order to sell at 60. That's a good thing, right? All right. The day trader. Everybody wants to be a day trader. It's fun. You make money, and you don't have to work. You just sit with your computer, make a few stock trades every day, and make money. You know, say you buy 1,000 shares of a stock, and it goes up by 25 cents. How much money did you make? $250 less commission, so maybe $230. In 5 minutes, you made that. Do that a couple times a day, you're making $1,000 a day, $5,000 a week. Who would want that job? But it's very risky, and most people I've ever witnessed, I had a lot of people swear up and down to me they're great at it. They make a lot of money with this, but I always find them some other point later in life. I ask them, well, how'd that day trading work out? Oh, well, not so good. I lost a bunch of money. I got out of it, and I'm doing something different now. Every time it's like that every time. So just be forewarned. Day trading can be fun. You can play around with the virtual stock exchange like that, but in your real life, it don't work. Okay, so lightning round tips for successful online trading. So you want to know how to place the order and confirm the order. So this you could practice with MarketWatch. And you want to verify the stock symbols. So you want to make sure that the stock symbol you're buying is actually the company you want to buy, because a lot of symbols can be very similar. They're like license plates, and you can easily mix up the letters and buy the wrong company. And a lot of people will tell, oh, buy XYZ company. You don't know what it is, and you mess up the symbols, and all of a sudden you're buying the wrong thing. I've even done it a few times myself, especially with ETFs. I get confused, and I think the letters, dyslexic, and I move them back and forth. So always verify. Use limit orders when you can to protect the price point, especially when you're buying. You want to put a limit order so you don't get a price much higher than you're willing to pay. You want to recheck your order for typos. You want to make sure it says 100, not 1,000. It could be, and you probably did this in the virtual stock market. You may have put the wrong amount of shares in, and all of a sudden, all your money's gone. They say to open accounts up with 2 brokers in case one fails. You have a backup. I don't really think that's necessary in this day and age, but you don't want to get too carried away and keep trading and getting desperate, and you don't want to have that gambler mentality. If you've ever been to a casino and you're playing poker or 21 or a slot machine and you start losing and you get desperate and you bet more and you pull more money out to invest, and you got to be a little bit sensible about it, not let your emotions get away with you. And you want to look at, the trading costs. The transaction costs can add up. So if you trade a lot and there's a lot of commissions build up, you could buy 1,000 shares of one stock and pay $7 for it, or you can continually buy 100 shares 10 times, and now you pay $70 commission. So it's sometimes better just to buy the whole block you're intending to buy at once if you want to hold the stock for long term. If it's a short-term day trading, then don't do that. But long-term, you would just, it pays in most cases just to buy it all at once when you're ready. There is, the FDIC for banks. There is an SIPC for brokerage accounts that is a little bit more extensive in protection your brokerage accounts from the broker failing. And you know what? Plenty of banks have failed, but no brokers have. So having your money in a brokerage account is safer than having it in a bank account, because plenty of banks have failed. I don't recall any brokerage ever failing. Okay. If there is a problem with your transaction and something messed up, there's arbitration, there's mediation, there's legal action you can take. And this is what happened, when Facebook came out, and this article we read talked about the trouble with Facebook. When that came out, does anybody remember what happened that was so bad? What's that? It was like really high. No, that's good. We all like to be really high when it comes to stocks. What happened was so many people were trying to get Facebook that it basically broke the network, and it couldn't trade, and it's shut down, and people had limit orders and stop orders, and these trades came back with all funky results, and there was a whole the volume just couldn't handle the volume of the stock on that first day. So some people had to go to arbitration, mediation, even legal to get their money back if the brokerage and the transactions were screwed up. If you do use an investment advisor, make sure they're registered with the SEC, and you want to look for advisors with experience. That's why college students aren't always the best investment advisors. People look at you like, well, what do you know? You're 22. But if someone has older and gray hair and it looks like he's been in stocks forever, you feel a little bit more comfortable with that person. And hopefully these people have either a CFA or a CPA. Those are two credentials that really matter. If you have a CFA or a CPA, you're starting your career with at least $100,000 or more to start. Any of these other credentials are really kind of not so meaningful and not that hard to get, except for CPA or CFA. So if you're interested in accounting, you should go and try and get your CPA. If you're interested in finance, to get the top financial professional designation is CFA, and that's what you want to. And it's actually harder than a CPA to get that, but it really sets you apart from everybody else and sets you up for a huge. That's one way you can compete with Ivy League students. If you want these big investment bank jobs, you have a CFA and a degree from a non-Ivy League school, you'll get the job ahead of an Ivy League student, because it's just really saying that it's really certifying that you know your stuff. Okay. Paying for an investment advisor, you're going to generally pay with commissions or an annual fee. And this is why I'd say, try to avoid these advisors if you can, because they take part of your profits. So if your portfolio return 15%, you may only actually get 12% after all the commissions and fees. So this is a way, if you could easily do it yourself in a safe, practical way, you can save a lot of money over your lifetime and not paying these fees. And it could be just as simple as buying 6 mutual funds, and that's it. And you'll be just as well set up and have a return greater than most stockbrokers can provide you. Unless you know some fantastic stockbroker that just has a reputation of 20% returns every year, then just pour all your money into this stockbroker. There are investment clubs you can join. These aren't as popular anymore, but people get together, talk about stocks. Sometimes they actually pool their money and invest together. And it's a good way of just keeping involved in the community and understanding. And this could be done even through just, nowadays you don't have to meet in person. You can do through message boards or different things. Yay, we're finally done. So that's chapter 3. These are our learning goals. We learned everything. Next class, we're going to start the next chapter. But I'm also going to take time to reinforce I have a handout for the market orders, how to trade, limit, short sell, stop, loss, all those things. So we'll talk about that next class. Have a great weekend, and I'll see you soon.